Welcome to the Jay Tyner Show, where we discuss all things wealth management and retirement planning. And as always, the goal of our team here at Semmax Financial Group is to help you focus more on your life and less on your money. Now, as a reminder, check with your current advisor, planner, CPA, and read our disclosure in the video description below. Subscribe to this channel if you want to stay up to date on all of our new content. And by the way, if you have questions or need a 15-minute free consultation, please visit semmax.com or call 336-856-0080.
Hello and welcome. My name is Matt. I'm joined by Larry. We are two of the advisors here at Semmax Financial Group, and today we're going to share with you 5 facts about inflation. Now, number one, right off the bat, I'll go ahead and say this. It shouldn't come as any kind of shock to anyone watching this video, but inflation is at levels that we have not seen in decades, and I don't anticipate that changing anytime soon. I think there's some fiscal situations that are going on. There are some economic policies that have taken place. We are in a situation where it is not the highest it has ever been, but we are not in a good area from that standpoint. They have been trying to raise interest rates to pull it down. That's having an impact, a minimal impact. There's a number of things that drive inflation. There's a number of reasons that we have inflation. I will say this, I think some inflation, however, can be a good thing. And when we're going to the grocery store and things are 8, 9, 10% more expensive than they were 2 weeks ago, that's not a good thing. But there is a level of inflation that is a good thing, and that's kind of the big second point that we've got here. So I'd like you to maybe explain where this can be a positive, because when you're feeling this almost unprecedented feeling of this ramp up like we were not accustomed to, it's not good to feel this way, and it's easy to go, how on earth is this a good thing? Right, exactly.
So the Fed shoots for that 2%. You know, they want us in that 2%. And the reason is it keeps things growing at a regular, steady pace, as opposed to deflation, for example. Deflation, prices drop, everything's more affordable or what have you, but it also cuts into profits because people sit on the sidelines waiting for things to drop further.
Right.
And therefore it causes the economy to suffer as well.
So you see this a lot with housing markets. You see a lot of volatility in prices in housing markets. Inflation says, oh my goodness, I got to go ahead and get a house because housing is just going to keep climbing.
Right.
But then that increased demand keeps driving houses up. But when housing's prices are falling, you look at it and go, well, why would I buy a house now? If I wait a month, it'll be lower,
exactly.
Which the guy who's now trying to sell, it keeps going down.
Mm-hmm.
So that 2% is what you're saying is kind of a comfortable,
right.
The markets are humming along, doing what they're intended to do.
Exactly.
Okay. Now, I will just say this. When it comes to measuring inflation, there's a couple different ways you can measure inflation. Now, the CPI, the Consumer Price Index, it's widely used, but it's not perfect. I would say it's probably the most broad and most recognized measure of inflation. But the thing is, this incorporates things that are slow moving. This is going to incorporate things like rent. It's going to incorporate the cost of mortgages. But what's happening here is it underestimates the real feel of inflation. Oftentimes, when we think of inflation, you're thinking, oh my goodness, gas prices have gone up how much in the last 3 weeks? When I go to the grocery store, it costs how much more than it did before?
Right.
When I go to buy those football tickets to that Panthers game,
right.
They're how much now? I remember when they were only...
Right.
But your rent hasn't changed much month to month, right? It's a little bit of a slower measure. So it is a way of doing it. But I would also say the commodities market is a little bit more closely tied to inflation. And so that sometimes when you see the numbers coming out from the government and you go, okay, the government said inflation's running at 7.3%. That's not what it feels like to me.
Right.
It's because they're looking at that CPI, which is also a lagging measure.
Right.
Right?
Exactly.
So what's the next one? What have you got for us?
Well, there are a handful of traditional hedges that you can use for inflation.
Okay. Now, what do you mind explaining what a hedge is against inflation? Because I think that's good to know.
Right. Well, a hedge is basically protection.
Okay,
It's basically a way to protect yourself against some of the effects of inflation.
Right.
It's not perfect. It's
So
not going to stop inflation by any means, but it will allow you to kind of balance things out a little bit.
So people think about hedging your bets, think about
Right.
hedging your investments against inflation.
Exactly.
Okay.
It goes along with being diversified,
Right.
which helps as well. So we talk about one of the big ones right now is the Series I bonds, for example.
Oh, yeah.
You can do that $10,000 once a year. You get the inflation adjusted rate, so you can get a decent return. So that's one way to do it. Real estate investment trusts, REITs, because you were talking about rents earlier.
Right.
You can raise rents, and therefore you can offset some of that inflation. And then you can get inflation-sensitive stocks, things that obviously are going to be in demand no matter what. Mm-hmm. You're going to pay your electric bill. So energy companies, Duke Energy, for example, around here, Coca-Cola, everybody's going to keep buying their Coca-Cola. Procter & Gamble, you still got to brush your teeth, wash your hair. Well, you do.
I was going to say, you're saving money on me on that one.
I'm saving money on that one. But those are some hedges against inflation.
Yeah. Now, here's the thing I would say, and this is kind of the fifth point, is what hedge you're going to use against inflation is going to be dependent for everyone, right? So it's dependent upon your plan. It's dependent upon your investment comfort. It's going to be dependent upon what you physically need. For some people, they're in a situation where they go, I am on a fixed income. I need something that is going to immediately respond to the costs of goods and services, right? And so you may be in a slightly different position than someone who goes, I really just want to make sure my portfolio can handle this volatility, can handle what's going on with inflation. And so whereas one person may want to go with more of those I bonds where you're getting that immediate adjustment, another person may be more comfortable with a little bit of risk because the market does have ups and downs.
Right.
Aside from inflation protection, there's other ups and downs, but historically, the stock market has been and likely will continue to be the best hedge against inflation.
Correct.
And the reason is, I'm going to put this in very simple to understand terms. A stock is nothing more than a part of a company. You own a piece of a company. Right. Well, when you own a piece of a company, right, what's happening is, as an owner, the company is growing, the company is generating revenue. Well, as things cost more, it costs you more as a company to operate, but then you're in turn raising your prices, so your revenue in some cases actually increases.
Right.
Now, the purchasing power might be reduced, but the actual revenue, the dollars coming in, have increased. At the same time, think about that stock price. The stock price is nothing more than what it costs for me to sell my piece of the company to you. So if everything is costing more, if the valuation of the company is going up, the revenue is going up, what do you anticipate to happen to that stock price? Stock prices typically climb as well. This is why the stock market is such a good hedge against inflation. Now, like Larry spoke of earlier, some companies are going to handle that differently than others. Some companies are going to respond well to inflation and actually have boom years. Others are going to see diminished returns because some things that are a little bit more of a luxury item or not a necessity, you may go, you know what? I'm feeling a little strapped for cash. I'm not going to buy that right now.
Right.
I'm going to wait until it levels off. It's not a little bit more of a reasonable price point. So when it comes to your approach for how you handle inflation, I think it's key to make sure it matches your investment strategy. That said, if you don't know how you are addressing inflation, that's a conversation you need to be having with your advisor. If you don't have an advisor, or if you'd like a second opinion, you're welcome to give us a call. You can reach us at 336-856-0080. I know Larry would love to talk to you about it, as would I, or any of the other number of advisors we have here. Hope you do well. Thanks for watching.